Hello everyone, my name is Junjie, a member of the Investor Solutions and Marketing team at Azalea. A very warm welcome to the Astrea 8 management presentation video. We are pleased to offer Singapore investors a new series of Astrea PE bonds. The Astrea PE bonds are a series of bonds backed by cash flows from a quality diversified portfolio of investments in PE funds. For the Astrea 8 public offer, both Class A1 and Class A2 bonds are available to retail investors, and we will share more details on the offering shortly. Azalea is committed to investor education, and this management presentation recording is to help prospective investors understand the Astrea 8 PE bonds before investing. Kindly take a moment to review the risk statement associated with investing in the Astrea 8 PE bonds. The prospectus in respect of the offering of the Astrea 8 PE bonds in Singapore can be downloaded from the Astrea 8 website. You may also collect a physical copy from selected DBS, POSB, and OCBC branches during operating hours until the date and time highlighted on screen. Anyone wishing to acquire the Astrea 8 PE bonds will need to make an application in the manner set out in the prospectus. Finally, this advertisement or publication has not been reviewed by the Monetary Authority of Singapore. The public offers of the Astrea 8 PE bonds are not directed at investors outside of Singapore. Kindly take a moment to review the disclaimers. Now, let me introduce our speakers before sharing a brief overview of the Astrea 8 PE bonds. Apart from myself, we have with us today Mr. Chew Eun Yao, Chief Investment Officer at Azalea, who leads in all investments in Azalea, including the development of all investment products like the Astrea platform. He has been deeply involved in the Astrea platform since 2014, including Astrea 4, the first listed retail PE bond on SGX in 2018. Prior to joining Azalea, Mr. Chew was a senior member of Temasik's private equity fund investments team, covering fund relationships in Asia and global secondaries. Before Temasik, he spent almost 10 years with two private equity firms, Standard Chartered Private Equity and Javco Asia Investment. I am Lim Junjie, Director in the Investor Solutions and Marketing team. I joined Azalea in 2015 and have been deeply involved in all Astrea transactions since, with a focus on marketing the bonds to institutions, retail investors, and banking channels. Prior to that, I was an analyst with financial institutions, IHS Markit, and FPA Financial. As shared, Astrea 8 is offering two classes of bonds, the Class A1 bonds and Class A2 bonds, to retail investors in Singapore. Both classes of bonds have a fixed interest rate per annum, payable semi-annually, and are expected to be rated investment grade and listed on the SGX main board. Here, we summarize the key terms of the Astrea 8 Class A1 bonds. These bonds are denominated in Sing dollars and have a mandatory call at the end of year 5 if conditions are met, such as there being sufficient reserves to redeem the bonds. Their scheduled call date, as shown here, is on the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on their scheduled call date, there will be a one-time 1% step-up in the interest rate. Next, we move on to the key terms of the Astrea 8 Class A2 bonds. These bonds are denominated in US dollars and have a mandatory call at the end of year 6 if conditions are met. Their scheduled call date, as shown here, is on the 6th anniversary of the bond's issuance. If the Class A2 bonds are not redeemed on their scheduled call date, there will similarly be a one-time 1% step-up in the interest rate. The legal maturity of both classes of bonds is 15 years. The offer of Class A2 bonds marks the second time we are offering a USD-denominated PE bond to retail investors in Singapore, and we are pleased to continue our efforts to broaden investors' access to private equity. We would also like to highlight that you may apply for both Class A1 bonds and Class A2 bonds during the offer period. This means you may make one application for the Class A1 bonds and another separate application for the Class A2 bonds in the way set out in the prospectus. We will elaborate more on this in the later part of this presentation. In addition to this video, we are also holding a live management presentation event. Eun-Yao and I, along with the rest of Azalea's senior management team, will be there in person to answer questions you may have about the Astrea 8 public offer of Class A1 bonds and Class A2 bonds. You may sign up for the event by scanning the QR code or via the link as shown on the screen. In this video, we will be sharing more about Azalea before going through an overview of Astrea 8. These will be covered by Eun-Yao. Thereafter, I will touch on the key risks involved in investing in Astrea 8 before taking you through the key takeaways from this management presentation. Finally, we will end off with a short educational segment to explain what private equity, or PE, is all about. I will now pass the time to Eun-Yao to share more about Azalea.
Hello everyone, I'm Eun-Yao, Chief Investment Officer at Azalea. Thank you for joining us here today to know more about the Astrea 8 PE bonds and Azalea. Azalea was set up in 2015 and is the parent of the issuer and manager of the Astrea 8 PE bonds. For those of you who may be less familiar with us, Azalea is an indirect, wholly owned subsidiary of Temasek, set up with a mission to make private equity accessible to a broader group of investors, including retail investors. As of 31st December 2023, Azalea's assets under management stands at $9 billion. We seek to deliver our mandate through three different roles. First and foremost, we are long-term investors in private equity with significant stakes in this asset class. We invest alongside investors in all our products, showing strong alignment of interest with our investors. As shared earlier, Azalea is an indirect, wholly owned subsidiary of Temasek, whose entities have been investing in PE funds for nearly 3 decades. Secondly, we are a developer of innovative products and platforms and seek to broaden PE access to investors. We have 2 flagship offerings: Astrea, which are PE bonds backed by cash flows from a quality, diversified portfolio of investments in PE funds, as well as Atrium, equity products that seek to provide investors access to top-performing PE fund managers globally. Finally, as a manager, we are committed to delivering high-quality investments for our investors. We have built up a strong, capable, and experienced team with deep connections and networks. We are fully committed to investor education, and we are excited to share more about the PE asset class and Astrea 8 with you today. PE has traditionally been an asset class that is difficult to invest into. Over the years, we have taken a phased approach to bring PE exposure to investors through innovative ways. We have been able to develop innovative solutions through our flagship offerings, the Astrea and Atrium platforms, to bring investors closer to private equity. The Astrea PE bond is one of Azalea's flagship innovations. The Astrea platform is a series of investment products based on diversified portfolios of PE funds for institutional and accredited investors, as well as Singapore retail investors to co-invest in private equity with Azalea. Here, we see the evolution of the Astrea platform over the years. Temasek launched Astrea 1 and 2 in 2006 and 2014 respectively, which were offered only to institutional investors. Thereafter, Azalea took over the development of the Astrea platform and in 2016 successfully launched Astrea 3, the first SGX-listed notes in Singapore, backed by cash flows from PE funds. The notes were offered to institutional and accredited investors. In 2018, Azalea launched Astrea 4, which was the first SGX-listed retail PE bond in Singapore. Through Astrea 4, retail investors in Singapore were able to invest in PE bonds for the first time, alongside institutional and accredited investors. This was a milestone in achieving Azalea's mission of connecting individual investors to private equity. Following Astrea 4, subsequent series of the Astrea PE bonds, Astrea 5, 6, and 7, were regularly made available to the retail public in Singapore across the years. Notably, the Astrea 7 launch in 2022 saw the offering of the more junior tranche US dollar denominated Class B bonds to retail investors in Singapore for the first time. Prior to Astrea 7, the US dollar denominated Class B bonds of all previous Astrea PE bonds were only offered to institutional and accredited investors. This marked another milestone in Azalea's mission to broaden access to private equity. The Astrea platform has a proven track record of fulfilling all bond obligations on time. This slide shows a summary of the performance of each series of Astrea PE bonds launched by Azalea since 2016, and is based on information published in the latest available semi-annual distribution report to bondholders for each Astrea PE bond series. Key highlights include the full redemption of Astrea 3 and Astrea 4. The bonds were fully redeemed as of January 2022 and December 2023, respectively. More recently, in June 2024, the Astrea 5 Class A bonds were fully redeemed as scheduled at the end of year 5. The portfolios of these Astrea PE bonds also generated healthy cash flows. For instance, at the point of full redemption for Astrea 3 and 4, the total portfolio cash distributions exceeded the initial portfolio net asset value, or NAV. Astrea 6 and Astrea 7, issued more recently in 2021 and 2022 respectively, continue to generate sufficient portfolio cash flows to support bond obligations. The Astrea PE bonds were also issued at healthy LTV ratios of approximately 40 to 45%. Post-issuance, the LTV ratios of the Astrea PE bonds were also progressively delevered throughout the tenure of the bonds, through the accumulation of reserves. Past issuance of rated Astrea bonds had investment-grade ratings at issuance and have enjoyed multiple ratings upgrades post-issuance. For instance, the Astrea 3, Astrea 4, and Class A of the Astrea 5 bonds achieved one or more rating upgrades since issuance, with all tranches rated A or above at redemption. As shown on this slide, the multiple rating upgrades received by the Astrea bonds over the years reflect the strong credit quality of the bonds. This is underpinned by Astrea's portfolio's quality, resilient performance, healthy LTV ratios, and the regular accumulation of cash reserves, which has helped to de-risk each Astrea transaction progressively over time. The Altrum platform is another of Azalea's flagship innovation. Besides the Astrea PE bonds, Azalea has also developed and manages a suite of equity investment products with the underlying assets in private equity. As Azalea strives to broaden PE access and develop relevant products for its growing investor base, the Altrum platform expanded over the years and now has 4 product lines, namely the Altrum PE Fund, Altrum Sustainability Fund, Altrum Growth Fund, and the Altrum Co-Investment Fund. Kindly note that at present, all offerings on the Altrum platform are only available to institutional and accredited investors. With the range of PE assets, Azalea has extensive experience in this asset class. The senior management team, as shown here, has deep networks and significant experience in investment and management of assets, as well as the development of financial and investment products. With that, this ends my introduction to Azalea. Now, let me take you through the Astrea 8 PE bonds in detail. Astrea 8 is backed by cash flows from a quality, diversified portfolio of PE funds, and investors may invest in 2 classes of PE bonds, Class A1 and Class A2. Both classes of bonds will be listed and traded on the SGX main board. This table here shows an overview of the 2 classes with their respective issuance sizes, expected credit ratings from Fitch, interest rates, scheduled call dates, and maturity dates. All the interest rates for the different classes of bonds have been set and priced by institutional and accredited investors through a competitive book building process. A portion of Class A1 bonds and Class A2 bonds are offered to retail investors in Singapore through the public offering. The remaining bonds were distributed to institutional and accredited investors through a placement offering. The Class A1 bonds and Class A2 bonds are expected to be rated investment grade by Fitch, as shown here, respectively. The Class A1 bonds have a fixed interest rate per annum, payable semi-annually, and are denominated in Sing dollars. The Class A1 bonds have a legal maturity of 15 years with a mandatory call at the end of year 5 if conditions are met. Their scheduled call date is in 2029, the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on their scheduled call date, there will be a 1% one-time step-up in the interest rate. The Class A2 bonds similarly have a fixed interest rate per annum, payable semi-annually, but are denominated in US dollars. The Class A2 bonds have a legal maturity of 15 years with a mandatory call at the end of year 6 if conditions are met. Their scheduled call date is in 2030, the 6th anniversary of the bond's issuance. If the Class A2 bonds are not redeemed on their scheduled call date, there will also be a one-time 1% step-up in the interest rate. Here, we summarize the key terms for the public offer of Astrea 8 to retail investors. Here are some key highlights of the Astrea 8 offering. We will cover these in detail in the subsequent slides. Here, we see the capital structure of Astrea 8. Class A1 and A2 rank pari passu, which means that they rank equally in the capital structure, or in other words, have the same seniority. This means the 2 classes of bonds have equal claim if an enforcement event occurs. The equity interest, which is 100% held by the sponsor, ranks junior to and after the Astrea 8 PE bonds. However, do note that each tranche is rated independently by Fitch, and the ratings reflect the credit quality of each tranche of the bonds. While Class A1 and Class A2 bonds rank pari passu, there are fundamental differences which result in a slight difference in the expected ratings of the two classes of bonds. The Class A1 bonds are denominated in Sing dollars, while the Class A2 bonds in US dollars. The Class A1 bonds also have an earlier scheduled call date of 5 years as compared to the 6 years of Class A2. Lastly, reserving for the Class A1 bonds begins from the start of the transaction ahead of the Class A2 bonds, which start from when the Class A1 bonds have been fully reserved or redeemed, whichever is earlier. One of the highlights of Astrea 8 is strong asset coverage. Astrea 8 PE bonds are issued at a conservative LTV ratio of below 40%. This means that the capital structure is over-collateralized, and the total amount of bonds issued represents less than 40% of the portfolio value. It also means that the value of assets of the portfolio value is more than 2 times the amount of the bonds issued. Since equity ranks junior to the bonds, if there is an enforcement event, equity will take the first loss ahead of the bonds. In other words, the Astrea 8 portfolio will need to lose more than 60% of its value before bondholders are impacted, thus mitigating the risk of loss for bondholders. At issuance, Azalea owns 100% of the equity portion, demonstrating our strong alignment of interest with bondholders. Another key strength of the Astrea 8 offering. As mentioned earlier, Astrea 8 is backed by cash flows from a quality diversified portfolio of PE funds. The Astrea 8 portfolio is geographically diversified across US, Europe, and Asia. There is a larger exposure to the US, which is the most developed private equity market, while Europe and Asia are fast-growing markets and provide diversification. The Astrea 8 portfolio is also strategically focused, with over 76% of the portfolio comprising buyout funds and the remainder in growth equity funds. There's no single name over-concentration in any funds or managers. The portfolio is also diversified across mature funds in different vintages and also across multiple sectors, reducing risk. The portfolio comprises over 1,000 investee companies across many different industries, and the largest investment in a single company is 1.3% of the portfolio NAV. This demonstrates how well diversified the portfolio is, with no single company concentration. Finally, here are some key highlights which serve as safeguards for bondholders. Firstly, there are the reserve accounts which are set up to build up sufficient reserves to redeem the Class A1 bonds and the Class A2 bonds on their respective scheduled call dates. Secondly, there is a feature called the maximum LTV ratio. If the LTV exceeds the limit, cash must be used to delever the structure by accelerating payments to the reserves accounts. Finally, there is a credit facility provided by OCBC. In the event of cash flow shortfalls, the credit facility can be used to fund certain expenses and other amounts payable, including unpaid accrued interest on the bonds and capital calls. However, the credit facility cannot be used to repay the bond principal. The transaction is managed by Azalea, and the cash flows are administered by Apex Fund and Corporate Services. On the right are the other counterparties involved in this transaction. We have OCBC acting as the credit facility provider. The credit facility can be drawn to pay capital calls issued by the underlying PE funds, pay interest on the bonds, or certain fees and expenses incurred by the structure in case of cash flow shortfalls. Other counterparties include the hedge providers, as well as the bond trustee and the security trustee. Here, allow me to explain in simple conceptual terms on how the Astrea 8 PE bonds are backed by cash flows from investments in 38 PE funds. Astrea 8 is the issuer of the bonds, and Astrea 8 subsidiary owns interest in the 38 PE funds. Altogether, these funds have invested in a total of 1,028 investee companies at launch. When investments in these companies are sold by the PE fund managers, the cash is distributed to Astrea 8. The cash can be used to fund capital calls at any time, and at the end of every 6 months, any remaining cash must flow through a waterfall called a priority of payments. How the cash can be used is strictly governed by this priority of payments. I will now share a simple conceptual illustration of how it works. Astrea 8 pays out every 6 months. Clauses 1 to 4 represent key fees and expenses necessary to run the structure. In Clause 1, available cash flow is used to pay for any taxes and administrative expenses up to a cap of $0.9 million per distribution period. In Clause 2, payments are made for amounts arising from the hedge arrangements. In Clause 3, payments are made for the management fees. In Clause 4, payments are made to pay commitment fees for the credit facility, as well as any interest and principal if the facility is drawn. Clause 5 represents interest payments to both Class A1 and Class A2 bondholders. As shared earlier, the two classes of bonds rank pari passu, and interest payments will be made on this basis. Clauses 6 to 8 represent cash used for reserves and principal repayments. If the issuer sells any of the PE fund's investments, Clause 6 ensures that the net cash proceeds from any sale after fulfilling senior obligations can only be used to fund the reserves accounts up to a prescribed amount cap. Clause 7 allows sufficient reserves to be built up in the reserves account for the redemption of the Class A1 and Class A2 bonds on their respective scheduled call dates. So long as any Class A1 bond is outstanding, cash will flow into the reserve accounts to build up reserves for the redemption of the Class A1 bonds up to the Class A1 reserve accounts cap, which is the amount required for full redemption of the Class A1 bonds. Once the Class A1 reserves accounts cap has been met, or upon and after full redemption of all Class A1 bonds, whichever earlier, 90% of the cash remaining after fulfilling the senior obligations will flow into the reserve accounts to build up reserves for the redemption of the Class A2 bonds. Similarly, up till the Class A2 reserves accounts cap, which is the amount required for full redemption of the Class A2 bonds. Clause 8 is a structural safeguard. This is where the maximum loan-to-value or LTV ratio is measured to ensure that there are sufficient assets remaining in the structure as buffer for bondholders. If the LTV ratio is exceeded, the sponsor cannot receive any cash unless more cash is set aside in the reserves account such that the LTV ratio falls below the limit. Clause 9 and Clause 10 covers any remaining expenses and costs. And finally, we have Clause 11 as payment to the equity investor. This concludes the overview of Astrea 8. I will now pass the time to Jinjie, who will take you through the key risks of investing in Astrea 8. Thank you.
Hi everyone. Once again, thank you for taking the time to join us today. It is important to remember that all investments carry risks. In this segment, we will talk about the key risks of investing in Astrea 8 PE bonds, which include investment risks, market risk, leverage risk, and exchange risk. Note that exchange rate risk is relevant for Class A2 bondholders only. First, let's talk about investment risks. The nature of private equity fund investments is that the amount and timing of distributions are uncertain. In addition, there are limited disclosures about the underlying investee companies and their performance, some of which could relate to a decline in returns or cash flows of the fund investments. Next, there's market risk. An adverse change in macroeconomic conditions, such as rising or elevated inflation, and or interest rates or market conditions, such as changes in the geopolitical landscape, such as those arising from armed conflict, trade tensions, natural disasters, or global pandemics, could result in falling PE asset valuations or reduction in deal activities. This could also result in less distributions from fund investments if exits on the underlying investments in investee companies occur during a period of declining asset valuations or deal activities. Thirdly, there's leverage risk. PE funds are likely to employ leverage, meaning the use of debt for investments. Use of leverage may expose investee companies to adverse financial or economic conditions and impair their ability to finance operational and capital needs. There is no assurance that the current interest rate levels will not remain elevated or not rise further. Cumulative effect of the use of leverage and adverse financial or economic situations could result in substantial loss to the portfolio PE fund or the investee companies, and increasing or elevated interest rates could exacerbate such losses. Finally, for Class A2 bondholders, there is exchange rate risk. It is important to remember that Class A2 bonds are US dollars denominated bonds. Class A2 bondholders whose investment currency is not in US dollars may be subject to exchange rate fluctuations between their investment currency and the US dollar. Such fluctuations may result in foreign exchange losses for these Class A2 bondholders. This concludes the segment on the key risks of investing in the Astrea 8 PE bonds. You may refer to the prospectus for more details on other risks. Thank you. Before we wrap it up for today's sessions, I would like to do a recap of the key takeaways. First, Astrea 8 portfolio NAV is approximately 2.5 times of total bonds issued, providing strong asset coverage. Secondly, Astrea 8 is backed by cash flows from a quality diversified portfolio with 38 PE funds over 6 vintage years and invested in more than 1,000 companies. Third, the Astrea 8 portfolio has a weighted average age of 6.1 years and is a mature and cash-generative portfolio. Fourth, as with all other Astrea PE bonds, the Astrea 8 PE bonds have strong credit quality. The bonds have investment-grade ratings and are designed with structural safeguards for bondholders. Fifth, Azalea is an experienced manager with a proven track record through regular issuances of the Astrea PE bonds since 2016, with all bond obligations fulfilled to date. Finally, at issuance, Azalea holds 100% equity interest in the Astrea portfolios, which ranks junior to the bonds. This signals strong alignment of interest with bondholders. We would like to highlight again that you may apply for both Class A1 bonds and Class A2 bonds during the offer period. You may make one application for the Class A1 bonds and a separate application for the Class A2 bonds in the way set out in the prospectus. While the Class A2 bonds are US dollar denominated, applications for the Class A2 bonds will be made in Sing dollars based on a predetermined exchange rate. Should you be unsuccessful in your application, or if you are only partially allocated, all refunds of unsuccessful or partial allocation will be credited back to you in Sing dollars at the same predetermined exchange rate during application. This means that as a Class A2 bond applicant, you will not be subjected to any foreign exchange volatility during the application period. As a Class A2 bondholder, do note that even though interest and principal payments on the US dollar denominated Class A2 bonds are made by the issuer in US dollars, you will receive Class A2 payments in Sing dollars by default into your designated bank account, converted by CDP at such exchange rate provided by CDP's partner bank. This is unless you choose to opt out from receiving payments in Sing dollars via CDP Internet. If you opt out, your foreign currency cash distributions will not be converted and will remain in your cash balance with CDP. However, please note there is telegraphic transfer fee imposed by CDP in addition to applicable receiving bank charges per withdrawal request. For more information, do refer to the Currency Conversion Service section under CDP's FAQ page at the URL as shown on screen. It is important to understand the Astrea 8 PE bonds before investing. You may read more about the Astrea 8 PE bonds in the prospectus and product highlight sheet. Printed copies of our prospectus can be obtained at selected DBS, POSB, and OCBC branches, or you can download a copy from our website. You may also watch our illustrated explainer videos, which are also available on our website. Finally, you may apply for the Astrea 8 PE bonds public offer through the following bank channels as shown on the screen. As a reminder, we will be holding a live management presentation event. Anya and myself, along with the rest of our senior management team, will be there in person to answer questions you may have about the Astrea 8 public offer of Class A1 bonds and Class A2 bonds. You may sign up for the event by scanning the QR code or via the link as shown on the screen. Now, for those of you who are less familiar, we will spend some time talking about private equity or PE, the underlying asset class of the Astrea 8 PE bonds. Kindly note that this segment is for informational and educational purposes only. PE, in general, refers to investment in private companies. Most PE investments are made by PE funds. The PE funds are managed by professional managers, also known as general partners or GPs. The GPs raise money from investors who are commonly referred to as limited partners or LPs. The GPs of the fund strive to improve the operations and financial performance of these companies before selling them for a profit. PE investments are common around us. Here are some general examples of PE-owned companies. I'm sure many of you are familiar with the football club Chelsea, but most of you didn't realize that it is owned by a PE firm. Kindly note that these are examples for informational purposes only and does not imply our endorsement. PE as an asset class has also been growing in significance. As shown in this chart, you can see that the private equity industry's asset under management has grown in the last 2 decades at an annualized rate of 12.7% to reach $8.5 trillion as of 30th June 2023. In terms of returns, private equity as an asset class has also outperformed the public markets over the longer term, as shown in this chart. The PE index shown here includes buyout and growth equity funds across the world. For those who are not familiar with the buyout and growth equity asset classes, these refer to different PE strategies. There are various strategies in private equity, such as buyout, growth equity, venture capital, and private debt. Of the various PE fund strategies, the buyout and growth equity strategies have historically outperformed venture capital and private debt, as illustrated in this chart, producing median returns of 16% and 14% per annum, respectively. Buyout funds focus on purchases of controlling stakes in companies to make operational improvements, while funds that employ growth equity strategy invest in fast-growing companies. The Astrea 8 portfolio is strategically focused on buyout and growth equity strategies only. To sum up, PE is an asset class with various positive attributes. Firstly, PE has historically outperformed public markets over the long term. Secondly, PE offers diversification to an investor's portfolio in general. Thirdly, PE offers investors access to opportunities which could offer higher returns with higher risks. Finally, PE is a long-term asset class suitable for investors with similarly long-term investment horizons and goals. Next, I would like to note some of the traditional challenges in PE investing. Here you can see the typical cash flow profile for an investor in a PE fund across its fund life that spans more than 10 years. In the initial years of the fund, there will be cash outflows as the GP draws capital to fund their investments. These cash outflows are represented by the red bars. Over time, once these investments grow and become profitable, the GPs sell them and generate returns for the fund, distributing cash back to investors. These cash inflows are represented by the green bars. You can see that the cash generative phase in the life cycle of a PE fund is in the later years, represented by the green shaded area. The net effect of the cash outflows and inflows is represented by the purple line. This is also known as the J curve because of its shape. To ensure more certainty over cash flows, Astrea portfolios only consist of secondary PE funds, meaning that the funds are in the later or mature phase of their fund lives when they are more cash generative. In addition, the Astrea portfolios are well diversified with many underlying investee companies and are managed by quality fund managers, further mitigating risks. As you know, all investments carry risks, so here are some general risks of investing in PE. Firstly, market risk. Changes in macroeconomic conditions, such as rising or elevated inflation and/or interest rates, could have an impact on the value of the investee companies held by the PE fund. Secondly, capital risk. The realized value or the eventual exit price of the investee companies may be affected by numerous factors, such as the quality of the fund manager, interest rates, use of leverage, and more. Thirdly, liquidity risk. Investments in PE funds are not easily sold as there may not be a secondary market for these funds. PE funds should be viewed as an illiquid investment. Finally, funding risk. PE funds also tend to have uncertainty in timing of cash flows, which poses a funding risk to investors. Capital commitments to PE funds are contractually binding, and defaulting on capital call payments could result in adverse economic consequences for both the investor and the PE fund. How can we manage some of the risks of PE investing? A diversified portfolio of PE funds can have superior downside protection as compared to investing in a single PE fund. Here, we compare the risk of capital loss of a single PE fund, a primary fund of funds, and a secondary fund of funds using historical data from Preqin, a database provider covering more than 9,100 funds from 1990 to 2019. A primary fund investment involves investing in PE funds at their inception, whereas a secondary fund investments invest in the fund at a later stage of their life through a secondary market purchase. Secondary funds are thus more mature and cash generative, mitigating the J-curve effect. As shown on this slide, investing in a portfolio of secondary funds has competitive risk-adjusted returns, with only 1% of secondary fund of funds experiencing a capital loss. The Astrea 8 portfolio comprises funds acquired on a secondary basis and is similar to a secondary fund of funds with a seasoned and cash-generative portfolio. In addition, the Astrea 8 portfolio is diversified across 38 funds, which are in turn invested in a diversified portfolio of over 1,000 companies across many sectors. Diversification helps to minimize the impact on your investment if any single fund or company performs poorly, lowering the risk of capital loss. PE has traditionally been an inaccessible asset class with high barriers to entry. Some of these barriers include high minimum investment sums, long holding period, and the J-curve effect, which we explained earlier. The Astrea PE bonds are developed to mitigate these challenges to connect investors to PE, as part of Azalea's mandate to broaden access to the asset class. Taking the Astrea 8 PE bonds as example, the bonds allow for bite-sized investments which means investors do not have to put up large amounts of capital to invest. The Class A1 bonds have a minimum subscription amount of 2,000 Sing dollars and are traded in denominations of 1,000 Sing dollars on SGX. Similarly, Class A2 bonds have a minimum subscription amount of 2,000 US dollars, and the bonds are traded in denominations of 1,000 US dollars on SGX. In addition, investors' capital is tied up for shorter amounts of time. The Astrea 8 Class A1 bonds are scheduled to be redeemed after 5 years, if conditions are met. Additionally, the Class A2 bonds are scheduled to be redeemed after 6 years, if conditions are met. Finally, the Astrea bonds are backed by cash flows from a quality diversified underlying portfolio of secondary fund investments, and this mitigates the J-curve effect. I hope this segment has provided a clearer picture of what the asset class of private equity is all about. With that, we have come to the end of this management presentation. Once again, I would like to thank you for taking the time to be with us today. Thank you.